An environment of low interest rates, in fact 150-year lows in interest rates, unstable stock markets, longer lifespans, uncertain retirements, unstable economies, people have two big questions on their mind. The first, how much do I need to save for retirement? How much do I have to put away to guarantee a reasonable retirement income? And then the second is, how do I deal with unstable markets? And I'd like to share with you the insights I've gained from the literally thousands of conversations I've had on this topic with concerned investors over time. I left off the last segment talking about the effects of inflation over time and the profound effects it had on two elderly women I'd had the pleasure to meet. And also the fact that for many of us, our retirements may last 30 years. So the question that a lot of people have is, how are we defining risk? So certainly market volatility is one form of risk, and one we need to be conscious of, and one that has to be managed. But the real risk that we face over very long periods of time is the effect of inflation. And I'll share a story with you. I was having a conversation with an entrepreneur who was convinced that he was taking the right approach to investing his capital. And he had about $1.8 million when I met him and I had this conversation. And he had invested started investing his money when he sold his business back in the 80s. And I had asked him, well, how much did you get when you sold your business? And he had received about $2 million for a sale of the business. And his view was that I still have about $2 million. I survived the recession of the 80s, the 1987 market crash, the tech bubble meltdown. I've kept my capital intact. And he felt that this was evidence of success in investing. And it certainly was evidence of his ability to preserve his capital. And what he did was that he was in fact an investor in stocks. And whenever he would see trouble in the markets, he would immediately sell his entire portfolio and wait for things to calm down. And then he would buy back his investments after whatever problem had passed. What he didn't realize was, in fact, that he had lost a great deal of money over this time. Because the market, and if we define the market by the advance of, say, an index like the Dow Jones Industrial Average, had increased fourfold over the same time period. So in fact, if he had left his money in a diversified portfolio of stocks, he would have 3 or 4 times the amount of capital he had today. This is a form of risk that you actually don't notice when you're going in and out of the market, because you're selling your investments and you're conscious of how much did I sell them for and how much did I put back into the market. But you're not taking into account what was the opportunity cost by me going out of the market for that time. And of course, none of us are able to predict what is a real market drop or a market crash and what just looks like one, and in fact turns out to be nothing more than a few headlines and a scare in the media or some temporary turbulence that quickly corrects itself. And by the time you're able to reinvest your money, in fact, the market may have advanced. So it's important to think about how it is you're defining risk. The risk isn't simply the market volatility or the risk that your capital may go down. It's also the effects of inflation over time. And what we found in the last segment, if we look at the cost of living over time, is that not only do you need to preserve your capital, you need to in fact grow your capital and your income over time in order to keep up with the effects of inflation. You'll notice in this slide that there's 2 postage stamps here. And again, to Canadian investors, I'll apologize. These are our US stamps. The images were simply easier to find. So the first stamp is a stamp from 1982, and back then it cost 15 cents to mail a first-class letter. In 2012, you see the same cost of mailing a first-class letter, except now it's 45 cents. So this is, if we use this as a proxy for inflation, this is one of the risks that we're looking to manage. Not only are we looking to manage volatility, but how are we going to keep people in stamps over the course of 30 years? And if we use stamps as the proxy for inflation, you need about 3 times as much capital in 2012 as you did in 1982. In this next slide, I'm taking a look at how $100,000 of income has to grow to keep up with a 3% increase in the consumer price index each year. So you can see from the first bar on the bar graph that 5 years in, your $100,000 has to be $115,927. And for a more extreme example, if we go out to year 30, and if you remember from our previous segment that the average retirement between a non-smoking couple who retire at age 62 is about 30 years, your $100,000 has to be $242,726 30 years on to replace the $100,000 that you started with. The fixed income line at the bottom of the slide at 3%, showing $66,000, is my presumption on what you could get on a fixed income portfolio based on $2.2 million, which was a number that we had used in a previous segment to figure out a retirement income. So $2.2 million at 3% is going to generate $66,000, which is simply going to mean that capital will erode over time in a purely fixed income portfolio if we're using $2 million to try to replace $100,000 of income. If we go back to 1982, when that first class stamp was worth 15 cents, or cost 15 cents to mail a first class letter, the S&P 500, which is an index reflecting the 500 largest capitalization stocks in the US, stood at 122 points. In this next slide, we're fast forwarding to 2012, and you can see that the first class stamp is there. It's now 45 cents, so the cost of mailing a letter has tripled since 1982. The S&P 500 index, however, has not tripled. It's gone from 122 points to 1,400 points. And this is the type of growth that you need in order to keep up for inflation and, in fact, index your income over time. In the next segment, we're going to talk about if markets work so well over time to deliver investor returns net of inflation, why do so many investors struggle to get a reasonable return out of their stock portfolios?